The real signal behind Bitcoin's weird price action is not fear, not hype, and not a broken market. And if you've watched price slam into the mid 120,000s, slide down toward the 80s, and then trap you in weeks of grinding nothing, this is the moment where most people misread what's actually happening. Because if you bought anywhere near 125,000 and price bled toward 90,000, the cost wasn't just dollars, it was confidence, time, and emotional energy. And ignoring the reason this happened is how people end up exiting right before the release. You didn't imagine this. The price action has felt wrong. Not scary enough to be a crash, not strong enough to be a rally, just heavy, sticky, exhausting. And here's the part that should bother you. Markets don't behave like this by accident, especially not after conviction peaks. When momentum disappears without panic, something else is holding it in place. Let me put you inside the exact moment this matters. You're watching Bitcoin push, stall, pull back, and every bounce feels sold into too early. You're waiting for follow-through. It never comes. And the longer it drags on, the more it messes with your read on the entire cycle. Most people stop there. They blame sentiment. They blame manipulation. They blame retail capitulation that never actually shows up. But the real answer sits somewhere most people never look. And once you see it, this entire move stops feeling random and starts feeling scheduled. And no, that does not mean predictable in the way people want. It means constrained. Now let me ask you something simple. If Bitcoin really was broken, why didn't it crash? And if it was still strong, why couldn't it rally? That contradiction is the clue. Because what you're watching is not price discovery, it's price containment. And the reason that matters is because containment always has an expiration. Here's where this gets uncomfortable for a lot of people. The market isn't confused right now. It's not undecided. It's not waiting for news. It's pinned. And once you understand who benefits from that pin and why, the weirdness starts to make sense. A few weeks ago, an institutional voice described Bitcoin as an asset of fear. At first glance, that sounds like a throwaway line, but framing matters. The argument went like this. When macro fear rises, Bitcoin gets a bid. When tensions ease, Bitcoin softens. Trade agreements, ceasefire chatter, easing uncertainty, all line up with dips. From that lens, Bitcoin isn't a momentum trade, it's insurance. And if you stop there, it kind of works, until you test it against reality. Because insurance is supposed to feel boring when you need it. It's not supposed to lose you $30,000 in a matter of weeks, and that's where the speaker hesitated. They admitted something most institutions don't like saying out loud. If you bought Bitcoin near the highs and watched it slide into the 90s, that does not feel like protection. It feels like volatility, and unless you are exceptional at timing, which almost nobody is, that kind of move feels irrational. That hesitation is the tell, because markets don't become irrational without a mechanism. This is the moment where the story flips, because the problem is not Bitcoin, it's the layer sitting on top of it. Bitcoin isn't being pushed around by emotion right now, it's being managed, and that difference matters more than almost anything else you could focus on. You hear the word manipulation thrown around constantly. That's not what this is. What's happening is quieter, more mechanical, and far more powerful. Bitcoin is being hedged. Large institutions and options dealers are sitting on enormous derivatives exposure, and they are not trying to control price. They are trying to survive it. Right now, the options market tied to Bitcoin is massive, not large, massive, and it all converges on a single moment. December 26th. This is where you need to slow down and really hear the numbers, because they explain almost everything you've been feeling. There are roughly 268,000 open contracts sitting in the Bitcoin options market heading into that expiration. Out of those, about 195,000 are calls, roughly 73,000 are puts. That gives you a put-to-call ratio around 0.38. In plain language, bullish positioning dominates, and all of that represents more than $23 billion in notional value expiring at once. That is not background noise. That is gravity. Now here's the number almost nobody talks about out loud. The max pain level sits around $96,000. That is the price where option holders lose the most money and dealers lose the least. Dealers are not villains. They're not sitting in a room deciding where Bitcoin should go. But when exposure gets this lopsided, their hedging behavior naturally pulls price toward that zone. Not because anyone believes Bitcoin is worth exactly $96,000, but because that's where risk is minimized. And once you see that, the last several weeks stop feeling mysterious. Every rally toward the upper end of the range feels heavy. Because it is. Every dip feels bought too early because it is. Stop runs look surgical because they are mechanical. Volatility feels suppressed because it's being absorbed. This is not a free market right now, it's a derivatives box. If you've ever wondered why conviction peaks right before price fails, this is why. It's not sentiment breaking, it's flow overpowering belief. Now let's talk about the word most people avoid because it sounds complicated. Gamma. Gamma gets treated like some advanced concept you need a math degree to understand. You don't. The intuition is simple. Options dealers sell contracts to traders. When price moves, dealers must hedge dynamically to stay neutral. If price rises, they sell spot or futures. If price falls, they buy. When gamma exposure is high, that hedging has to happen aggressively and constantly. Right now, gamma is doing something very specific to Bitcoin. It's creating a cage. That cage sits roughly between the mid-80s and the low 90s. Every time price pushes up toward the top of that range, dealers sell into it to neutralize exposure. Every time price slips toward the bottom, they buy to offset risk. Not because they think it's cheap, not because they think it's expensive, but because their books demand it. This is why breakouts feel fake. This is why dips don't flush. This is why the market feels like it's stuck in mud. And here's the part most people miss. This behavior has nothing to do with long-term direction. It's temporary. Gamma pressure does not last forever. It lasts until the exposure expires. And that brings us back to December 26th. On that date, a massive chunk of this options exposure simply disappears. When that happens, several things change all at once. Hundreds of millions of dollars in gamma pressure vanish. Dealers no longer need to aggressively hedge within this narrow corridor. The artificial gravity around the mid-90s weakens. And rebuilding that kind of options wall is expensive. It takes time, liquidity, and active participation. Dealers do not casually recreate multi-billion-dollar structures overnight, especially not during a holiday week when liquidity is thinner and risk desks are cautious. This is the part that matters most. When the pin releases, Bitcoin does not need a new story. It does what it always does. It follows its dominant trend. Now let's zoom out, because this is where people either get impatient or they get positioned. Longer-term valuation models, including power law-based approaches, place Bitcoin's fair value closer to $118,000 right now. That does not mean price must snap there instantly. Markets don't work that way. But it does mean something important. The longer price is suppressed below value, the more violent the resolution tends to be. Suppression builds potential energy. Release converts it to movement. Once enough gamma rolls off, behavior flips. The same flows that sold into rallies start buying strength. Dealers stop acting as resistance and start amplifying moves. Call strikes clustered at 100,000 and 120,000 stop being ceilings and start becoming magnets. That's how suppressed markets break, not gradually, suddenly. And this is where a lot of people make the wrong comparison. They look at this drawdown and think it feels like a cycle top. But when you actually look at the structure, it doesn't match. One of the strangest features of this move is how little leverage was in the system relative to past cycles. Even before the pullback, leverage compared to market cap was significantly lower than what we saw in previous blow-offs. Even after the decline, Bitcoin sits below leverage levels common in traditional equity markets. And that tells you two things. This was not a euphoric excess. And the washout cleaned up weak positioning without breaking structure. Retail composition has changed too. There are fewer short-term gamblers chasing overnight multiples and more medium-term holders expecting multi-year returns. That shift matters because it changes how pain expresses itself. Instead of sharp crashes, you get long stalls. Instead of panic, you get doubt. And doubt is far more corrosive over time. This is why the move feels confusing. There's no clean headline, no obvious macro trigger, no systemic failure, just positioning unwinding quietly while price goes nowhere. And if you're not looking at the derivatives layer, it feels like the market has lost its mind. Now let's address the elephant in the room. Bitcoin does not trade in isolation anymore. CME gaps matter. ETF flows matter. Options expiry matters. This is not Bitcoin losing its edge. It's Bitcoin growing up. When price pushed toward 125,000, something very specific was happening underneath the surface that most people barely noticed. A CME gap was opening below price. Now that detail matters way more than people like to admit. In a market that's increasingly dominated by traditional finance participants, CME gaps aren't just curiosities, they're unfinished business. In legacy markets, gaps like that tend to get revisited, not because the market is bearish, but because liquidity seeks balance. It's less about sentiment and more about structure. So even while everyone was feeling euphoric, even while narratives were lining up perfectly, even while conviction felt unshakable, the groundwork for a pullback was already there, and that alone made a retrace likely. Not guaranteed, but structurally probable. That's the part people struggle with emotionally. They look at strong sentiment and assume price should only go one direction. They expect momentum to behave the way it used to. They want Bitcoin to act like it did when it was smaller, thinner, and easier to move. But size changes behavior. As markets grow, they don't become cleaner, they become heavier. Deep markets don't explode immediately, they compress first, they absorb, they constrain. That's how liquidity works. Before a large move, the market needs to transfer risk. It needs time for positioning to reshuffle. It needs room to clear excess exposure without blowing itself apart. And that clearing process rarely looks bullish on the surface. It looks boring. It looks frustrating. It looks like nothing is happening. But under the hood, pressure is building. This is where the timing starts to matter. Post-expiry periods in Bitcoin have a very specific character. Not because Bitcoin is magical, but because the mechanics change. Once large options positions roll off, the market loses a layer of artificial stability. The dampeners come off. Volatility doesn't just increase randomly, it expands because it's no longer being absorbed. Trends don't magically appear, they reassert because suppression ends. And acceleration doesn't come from excitement, it comes from flow flipping direction. If Bitcoin can reclaim the key gamma flip zone around the high 80s and actually hold it, something important changes. Dealer behavior reverses. Instead of selling into strength to hedge risk, dealers begin buying strength to stay neutral. Instead of capping price, they start amplifying it. Levels that used to act like ceilings turn into magnets. Resistance stops pushing price down and starts pulling it higher. That's when the vacuum opens. And vacuums don't move slowly. A move toward 100,000 and beyond doesn't require a new narrative at that point. It just requires space. Now, none of this means price moves in a straight line. Bitcoin has never worked that way. It overshoots, it snaps back, it tests conviction repeatedly. That unpredictability is part of its nature. But unpredictability is very different from stagnation. And that's the key distinction. The last few weeks didn't feel wrong because Bitcoin was failing. They felt wrong because price was being managed. Not emotionally, not narratively, mechanically. They weren't random. They weren't broken. They weren't signaling weakness. They were constrained, and every constraint has a clock. Now I want to pause here for a second because this is the moment where people stop hearing mechanics and start projecting outcomes, and that's not what this is meant to do. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Now that we've cleared that, let's finish the thought properly. The takeaway here is not that December 26th guarantees anything. That's where people consistently get themselves into trouble. A date shows up on the calendar and the brain immediately wants to turn it into certainty. A promise, a moment where something must happen. It becomes a prediction. Then it becomes a countdown. And before you know it, expectations are doing more damage than price ever could. That's not what's happening here. Nothing magical happens just because the clock ticks over. Markets don't care about your calendar. They care about structure. The real takeaway is that December 26th removes a constraint. And that distinction is everything. A guarantee tells you what must happen. It implies inevitability. It implies safety. A constraint tells you something very different. It tells you what has been preventing movement and what is no longer in the way. Markets don't need certainty to move. In fact, certainty usually slows them down. Markets move when they're allowed to. They move when pressure is no longer being absorbed. They move when flows are no longer forced to neutralize risk. They need freedom. And once that freedom returns, price stops behaving politely and starts behaving honestly. That honesty doesn't always look clean. It doesn't always feel good, but it's real. Markets behave completely differently when they're constrained versus when they're free. Constrained markets feel heavy. Every push feels like it's dragging a weight behind it. Every bounce feels muted. Every breakdown feels like it refuses to follow through. They feel sticky, like price is moving through thick air, like there's an invisible hand slowing everything down just enough to be frustrating. Every move runs into resistance you can't see on a chart. Not a level, not a line, just pressure. Free markets feel uncomfortable in a different way. They feel fast. They feel loose. They feel like things happen before you've had time to think them through. Moves extend, retracements snap. Price doesn't wait for permission. That's the contrast most people miss. What you've been watching recently is not a lack of interest in Bitcoin. It's not a lack of belief in the long-term story. And it's definitely not people quietly giving up and walking away. It's a market where hedging flows have been dominating price. And hedging flows don't behave like opinions. They don't care about narratives. They don't care about conviction. They don't care how bullish or bearish you feel. They exist for one reason only: risk management. When those flows are active, they do something very specific to price. They cap upside and support downside at the same time. Not because price is fair there, not because value has changed, but because balance sheets demand it. They smooth volatility, they compress range, they sand down every sharp edge, and that's what makes price feel unnatural. That's why rallies feel like they're sold into before they even get started. That's why dips feel like they're bought before fear has a chance to build. That's why nothing follows through long enough to feel satisfying. It's not confusion, it's containment. Once those hedging requirements roll off, price is allowed to express something real again. Not something clean, not something polite, something real, actual demand, actual fear, actual conviction. And that expression is messy by nature. It can overshoot, it can move too far too fast, it can snap back violently and punish late entries. It can whip people out on both sides. That discomfort doesn't mean something is wrong. It means the market is alive again. But one thing it will not do is sit still and slowly drain you emotionally. It won't trap you in endless indecision. It won't make you question whether anything you understand still applies. And that's the mental shift I want you to walk away with. This wasn't manipulation. It wasn't some hidden group deciding Bitcoin shouldn't go higher. It wasn't a failed rally that somehow lost its way. And it definitely wasn't Bitcoin losing relevance or momentum. It was Bitcoin being temporarily handcuffed by its own success. The more Bitcoin integrates into traditional market infrastructure, the more these moments show up before major moves. Options introduce hedging pressure. ETFs introduce flow constraints. Institutional participation introduces balance sheet management. All of that adds weight to price before it adds fuel. That weight feels frustrating in the moment, but it's also what makes the eventual move meaningful. And when those handcuffs come off, the move that follows rarely gives you time to get comfortable. It doesn't send an invitation. It doesn't wait for consensus. It doesn't ask if everyone is ready, and it moves first. And it explains later. That's why so many people miss it. They're still waiting for clarity when clarity only comes after the fact. Now here's the part that matters beyond this specific moment, because this is where smart viewers lean in instead of checking out. Understanding this structure doesn't just help you with Bitcoin. It changes how you read markets altogether. You stop asking why price feels weird. You stop asking why something that should work isn't working yet. You stop assuming the market is broken every time it behaves differently than your expectations. Instead, you start asking better questions. Who is forced to act at this level? Who is hedging risk instead of expressing belief? Where does pressure build if price moves higher? Where does it build if price moves lower? And what happens when that pressure is removed? That's a completely different lens. And once you start seeing markets through that lens, a lot of noise just loses its grip on you. Headlines stop driving your decisions. Short-term sentiment stops hijacking your emotions. You stop reacting and start observing. That's also why I spend so much time breaking this down inside Cheeky School, because market structure is the part most people never learn. They learn stories, they learn indicators, and they learn patterns. But structure tells you why those things work sometimes and completely fail at other times. And that's the real edge. Not prediction, not calling tops or bottoms, context. So if the last few weeks made you question your read, that's not a weakness, that's the beginning of understanding. Discomfort is usually the signal that your framework is updating. And once that update happens, weird price action stops feeling threatening and starts feeling informative. Because this weirdness wasn't a warning sign, it was a signal. Watch the next video.